Chapter 11, Section 4 is on operating cash flow, sales volume, and break-even. They go through a very long example of the Wetway Sailboat Corporation. And Wetway is considering a new class of sailboat. The sale price will be $40,000 per unit, and the variable cost per unit will be $20,000. It's unfortunate that they chose $20,000 since the difference between 40 and 20 is also 20, but it is what it is. The fixed costs are $500,000. The total investment is $3,500,000 and is depreciated straight line to zero over 5 years, which means $700,000 per year for depreciation. Salvage value is projected to be zero, and there is no working capital consequences. 20% rate of return is required on new projects. Based on market surveys, they anticipate being able to sell 85 boats per year. Now, this example all the way through is going to ignore taxes. Don't let that bother you. It's just simplifying things. The operating cash flow, then, we could calculate for 85 boats per year. Operating cash flow, you recall, is EBIT plus depreciation minus taxes. And since we're assuming taxes are zero, EBIT is equal to sales minus variable costs minus fixed costs minus depreciation. And then we add back depreciation, but since there's no taxes, there's no reason to subtract depreciation and add depreciation. It's not a cash flow anyway. So basically what we have then is the sales, which are 85 times 40,000, minus variable costs, which are 85 times 20,000, minus the fixed costs, which are 500,000. And when we plug the numbers in, we get $1,200,000 per year. So they use annuity factors, but we'll use the calculator. And I'm in cash flow mode, second clear TVM, second clear work, clear again, and I'm going back into cash flow mode. And I've got 3,500,000. Change signs, enter, down. And my annual operating cash flow is $1,200,000, so 1,200,000. Enter, down, and it's equal for all 5 years, so my frequency is 5, enter, down, and I'm going to do NPV, and it says what rate, and I say 20%, enter, down, compute, and I get 88,735, which is this number here. So the NPV for 85 boats, that's our projected amount, our NPV on this project, $88,734.57. Now, what about break-even? Well, our contribution margin is $20,000 per boat. Depreciation is $700,000 per year, and fixed costs and depreciation total $1,200,000. That's $700,000 for depreciation, $500,000 for fixed costs. So our break-even then would be our fixed costs plus depreciation divided by the price per unit minus variable cost per unit. So 500,000 plus 700,000 divided by 20,000, which is 60 boats. So 60 boats would get us our break-even for net income. So let's just sort of work our way through this. Again, we have operating cash flow is our price per unit times quantity minus variable cost per unit times quantity, and then minus fixed costs and minus depreciation, and then we add back depreciation, but since taxes aren't being considered, there's no cash flow here and there's no cash flow here, and they offset each other. So all we have is price minus variable times quantity minus fixed cost. And when we plug those numbers in, and they're dropping thousands here, and that makes it a little bit confusing. But if we look at the operating cash flow, then it's equal to minus 500, and that is fixed cost or 500, plus 20,000 times the number of units. All this table does is say, well, at different levels, different quantities, what would our operating cash flow be? And so it just plugs in it's zero quantity. 20 times 0 is 0, and add that to a negative 500, and you get negative 500. And it does it for all the different levels. And it looks something like this. Notice that the y-intercept is at minus 500, and that's because minus 500 is the outflow for fixed costs. And this would be a slope of 20, really 20,000, but we take care of that by having the units be different on the two axes, much higher numbers here on the vertical axis than on the horizontal axis. Okay, so we have already calculated accounting break-even, but let's just take a look at it again. Accounting break-even says fixed cost plus depreciation divided by price per unit minus variable cost per unit, or contribution margin per unit, and that gives us 500,000 plus 700,000 divided by 40,000 minus 20,000, and that gives us 60. So that's our accounting break-even. Now we might also consider cash break-even, and what we're looking at here is that point where operating cash flow is equal to 0. Calculate cash break-even, the point where operating cash flow is equal to 0. And that is our quantity equals the fixed cost divided by price minus variable cost. So we drop depreciation because depreciation is not a cash flow. So fixed cost divided by price minus variable per unit would be 500,000 divided by 40,000 minus 20,000, and that gives us 25. So here is our cash break-even at 25. Then we look at financial break-even. This one's more complicated. We're looking for that point, or that sales level and quantity of units, that Q that would give us a 0 net present value. So this might help. The project has a 0 NPV when the present value of the operating cash flows equals the $3,500,000 investment. Because the cash flow is the same each year, we can solve the unknown amount by viewing it as an ordinary annuity. Well, we're going to do that, but we're not going to use factors. What this is essentially saying is if you have an outflow of $3,500,000, and if you have a required rate of return of 20% and it's over 5 years, what would the cash flow, operating cash flow, have to be for you to have a 0 NPV? That is, the present value of the operating cash flows minus the outflow to be equal to 0. That would give you a net present value. $3,500,000 out. We've got some operating cash flows. We don't know what they are. We're trying to calculate that. Over 5 years at 20%, what would that have to be? Now, we'll use the calculator rather than factors. So we turn on our calculator, go into cash flow mode, clear everything out. And actually, we don't have to be in cash flow mode. We can just put $3,500,000, and I will go ahead and put the full number in there. $3,500,000, change signs as our present value. And we've got 5 as our N. We've got 20 as our I. Compute the payments, and that says that our cash flow every year would have to be $1,170,329 approximately. Okay, if that were the case, then when we plug this in, so fixed cost plus operating cash flow, and that operating cash flow is this 1170. When we plug these in together and divide by the price per unit minus the variable cost per unit, we end up with 83.5. Put another way, 83.5 would be that level of sales every year that would cause you to have a zero net present value. Of course, you don't sell half of a sailboat, so they rounded up to 84. And so I'm not sure how well that showed up while I had the calculator on here. Let me take a look. Yeah, I kind of faded things out a little bit, but you have it in front of you anyway, I guess. So if 83.5 would be our financial break-even, our NPV equals 0 break-even point, then we'd have to sell 84 units to break even. We only project that we're going to sell 85 units. And that means if we're 2 boats down from what we project, then it puts us into a negative net present value area. So we have to ask ourselves, is this project worth doing? And it's not so clear that it is worth doing. It sounded like it for a while because the accounting break-even was so low and the cash break-even was even lower, but we're concerned about net present value, and our net present value is really pretty shaky in this project. This table is probably helpful, especially when it comes down here, looking at operating cash flow and how that fits in. So you might want to look over here to this section, go through each of these. This is kind of the general case, but accounting break-even, cash break-even, financial break-even. And I think if you spend a little time on that, it might make more sense.